Super quick computers and advanced mathematic formulas have largely taken over trading on the financial markets from human beings. Algorithms, which seem to have a life of their own. Algorithms secretly lie waiting for the moment that your Apple share or your pension money gets on the market.
Alrighty, what's going on, everybody? I hope that you all have had a good week so far. I myself have had a very interesting week. It's been productive. At the end of the day, you guys know that I'm not a seller, and so the vast majority of price action this week so far has been sell positions. We'll talk about that in a second when we do the broad overview. But in a nutshell, in today's video breakdown, I have, like I always do, at the end of every single few days of the business month, done an entire backlog of fundamentals and pinpointed all of the happenings that took place in terms of the fundamentals that drove market sentiment for the month of May. And I want to go back and do an overview of what things took place, what headlines broke, what drove market sentiment risk on, risk off. So that way you guys have a very clear perspective moving forward on what things you need to pay attention to as we roll over into June, because a lot of these things are going to remain intact and remain similar to previous months, both back in April and in May, where we saw the market significantly rally and appreciate in value. We're going to continue to pay attention to these factors and cover them intraday in this community day by day. If you're new here, make sure that you guys are reading the daily reports. Make sure that you guys are listening to the audio version of the reports that Father Woody gives. Make sure that if you miss Zoom calls, you go back and you watch previous Zoom calls. So that way you're always filling the void of information and you know what's going on. You're aware and awake to what's happening in the markets and you don't get caught on the wrong side. During the month of May, I think our top gainer has been Zebec for the vast majority of us. Now, Zebec was a digital asset that we were paying attention to last year when nobody else was paying attention to it. One of our head researchers called it out in this community and started dropping a whole bunch of documents and fundamental related texts in the CYPRX research section last year in March on Zebec, which is when I started paying attention to it. And then I brought it to your attention when we had a discounted opportunity at the beginning of this year in March. And so from those discounted opportunities that I'd called out to you guys or it was maybe April, it was either April or March. I don't remember off the top of my head. There's screenshots in the Discord to go back and backtrack when I called it out for you guys. Long story short, we've seen over a 400% rally from those Zebec callouts that I gave you guys, which is our second biggest callout this year so far. So off the top of my mind, Shekel has performed over 800% this year for us. Zebec has performed over 400%. So far we're on track to hit at least, I'd say, another 2 or 3 huge call outs this year. We're only in the middle of the year, so we have another 6 months left. So I'd say that that gives us enough room to see some other massive gains in price appreciation, some assets that we're going to continue to pay attention to in this community, which has been significant. Last year or in previous years, we've had some really great call outs. Soy being one of the best call outs in this community, performed over 1,000% returns from some call outs that we were making at like 50 cents. And then it rallying all the way to $5.50. Not to toot my own horn, but again, this just goes to show the research that we provide here, how it eventually pays off if you're patient, if you're not fearful when everybody else is, and if you dial in and you really pay attention to some of the things that this community provides. So hopefully you guys are benefiting from that. I know that there's been a lot of talk and rhetoric and also trendy posts surrounding Zebec. I personally, because people have been asking me, I'm not dollar cost averaging in anymore because compared to where I was buying at the beginning of the year and last year, price is not discounted for me anymore. So again, to each his own, do your own personal risk analysis. Maybe if we get a significant pullback or decline in price, I'll add to my Zebec positions. But I'm personally comfortable with where my portfolio is sitting at now. It's sitting in some hefty profits right now. So just because I had like 5 or 6 people from the community ask me what I'm doing, I thought that I'd announce that. All right, so let's just kind of backtrack. Let's thoroughly go over the month of May. This is Bitcoin's price action. As I mentioned, I kind of messed up. I usually do this analysis on the total cryptocurrency market cap so that nobody thinks that this is biased towards Bitcoin. But regardless, Bitcoin is the dominating player in the market. So, it does move the rest of the market. And so it's fine that we're just utilizing Bitcoin's price action to track everything that took place. Long story short, we're going to full circle back to these because these risk on and risk off factors are going to continue to play a significant role until we either exit this headline-driven environment, which I personally don't see happening for at least the first year and a half of Trump's presidency.
We are very much in the 4 years of headline trading again. And look, I think people tend to have short term memory sometimes and forget that the first 4 years of the Trump administration were exactly this, where trading was felt very emotional and very reactive to headlines, and we're now in the tariff and inflation cycle, where we're there's just a reaction to every announcement that comes out weekend or weekday.
And so we're still in that window, which means that I personally think that these headline driven, trading intraday sessions are going to continue to dominate market sentiment until we at least head into maybe like some utility cycle where financial institutions really finally get the green light to start to integrate and utilize these digital assets for their underlying utility. We're going to remain in this headline driven month to month cyclical environment where we're going to see bullish months, bullish weeks, bearish weeks. And we're not going to operate in the normal trajectory of this 4 year ideology behind this bullish and bear market cycle, right? So,
One thing that I've kind of been thinking about today, even, is just I think you hear a lot of people talking about how the crypto space is purely narrative driven. You have to understand the narrative, and that's all there is to it. But I think that's a fact of the market because it is primarily retail driven now. And the other big thing everybody talks about is the institutions coming. And institutions aren't going to behave like retail investors. So I think that when you're creating a trading strategy, an investment strategy, you want to be focused on how the market is going to evolve, not exactly how it's been. How it's been, coincidentally, has not been around for very long. You're working off of 5 to 10 years of good data. So I think you can't just take what has happened in a retail that's been driven by, in a market that's been driven by retail, and expect that once it matures and institutions get involved, that it's going to behave the same. So I think that, just following the hype, just looking at narrative, I don't think that's a sustainable source of alpha, just to be, sniping the next big narrative that gets big on Twitter.
we're going to continue to play this narrative. So for the risk on drivers for now, that is what this list consists of. So I'm just going to thoroughly read this to you, and then we'll full circle back to it and give an overall trajectory of what the market could possibly do heading into June. All right. Number one, some things that have been risk on drivers. Any EU, China, Japan, or any major jurisdiction deals or negotiations of progress before the July 9th deadline. So that's something that we're definitely going to be paying attention to. I think that June is going to be extremely heavy as we inch closer towards that July 9th deadline for all of this tariff rhetoric. All right. Dovish Fed tone. Fed speakers that are reinforcing 2025 rate cut bet expectations, mentioning any liquidity injections or certainty in the economic outlook without hinting at renewed inflation worries. Any U.S. data that dips just enough to justify easing from the Federal Reserve while also supporting the U.S. soft landing narrative or the Fed's soft landing narrative. Okay. On the Middle East front, any de-escalations in Iran-U.S. nuclear talks or, any or seeing no flare-ups between Israel and Iran and all of that, in the Middle East debacle staying contained. All right. Any stable Russia-Ukraine conflicts. So no further large scale strikes, any ceasefire chatter or any peace agreements that gain traction. Reducing safe haven demand is something that we're going to pay attention to that could drive risk on sentiment as we roll over into June. Something that we for sure need to start to continue to be mindful of is we have recently seen an uptick in Japanese inflation and economic performance, right? Which has increased the probability or the odds of a rate hike from the Bank of Japan later on this year, albeit the market's not pricing that in until October. As of right now, it's still something that we need to be mindful of as we get closer to that time horizon. So the Bank of Japan staying patient is ideally what we would like to see, or making announcements that they're not in a rush to hike rates would be a risk on driver. And yen carry trades remaining intact, keeping global liquidity flowing, right? No excessive yen strength that unwinds carry trades is ideally what I'm trying to say here. And then just overall a calm headline flow, quiet news tapes throughout the week, allowing technical momentum to attract fresh risk on bids. And then, as I mentioned, just any positive trade negotiations or positive regulatory announcements surrounding ETFs, approvals, regulatory, signings like for the stablecoin bill that's happening, any major regulatory approvals that allow for financial institutions to get the green light to come into this space is also what we're going to be paying attention to rolling into June. All right. And so these, as we go over the month of May, have continued to be our risk on drivers, which you're going to see thoroughly as I break down each fundamental. And then on the inverse of this, right, you can pretty much just flip this on its head. The risk off drivers have been the inverse. So to save time, any tariff talk collapse, the Trump administration appealing the recent court ruling banning Liberation Day tariffs is something now that we need to pay attention to, right? As just recently, we'll go over at the end of the month of May, the fundamentals that just broke, the International Trade Court or whatever it is, they pretty much banned the Liberation Day tariffs for now. The Trump administration still has the ability to appeal what the court just announced. So that could obviously, of course, spark uncertainty in global markets and create a fresh risk-off environment as investors tend to hedge against uncertain conditions with safe haven demand. All right. Any hawkish Fed surprises, any strong data or tough inflation rhetoric that pushes rate cut hopes even further out than what they're currently being priced in now for September, and seeing dollar strength. Or we could obviously, of course, see any recession signals. So any data that sparks recession worries, any significant decrease in strength in the economic, stability that we've seen recently, sparking recessionary fears, markets starting to price that in. On the flip side of that, we could also see a scenario where we see excessive strength in economic data, boosting strength for the dollar and pushing back on those rate cuts. So we're kind of in the middle ground there for a risk on mood. We want to see data that supports the soft landing narrative, and anything outside of that, hinting at a recession or excessive strength, pushing back rate cut hopes, is going to give a risk off environment intraday. Middle East tensions, anything escalating in the Middle East between Iran, the United States, Israel, and Iran, anything on that front. Russia, Ukraine, same thing. Any major announcements of attacks, any further pushback on the ceasefire or peace talks could obviously, of course, escalate uncertainty in the market. Last two things, Japanese front, any upside shock in inflation data that we see driving excessive yen strength and increasing the odds with a higher probability of rate hikes from the Bank of Japan could obviously, of course, weigh on intraday risk sentiment, as stronger yen usually tends to reflect itself in an unwinding of carry trades and usually tends to put sell pressure on riskier assets, stocks and crypto. And then any just headline whiplashes, right? Any negative surprises, any negative sentiment surrounding ETF approvals, any negative rhetoric surrounding regulations. You guys kind of catch that drift. Any major collapses of exchanges that could go bust, or any rug pulls of projects that have a significant amount of capital in them that get pulled. Obviously, of course, those are all black swans, but still stuff that we need to be mindful of. All right. So we'll cover that. We'll come back. We'll full circle to these infographics right here as we stem and do our overall projection of what could possibly take place looking at price action during May. All right. So going back to the first week of May, starting here, we're going to be on the 8-hour time frame, and every single one of these posts I will expand so that way you guys can thoroughly see them. So as we ended April, and this is something that some of our mentors like Kev have mentioned before, we tend to see this where even if we've had an excessively bullish month, the first week of the next new month usually tends to be this pullback phase where the market readjusts itself. Sellers are able to come in, show their hand, push price down into a discount, then buyers come in usually if the market still remains risk on rolling into the new month, and buyers come in and defend their positions. And it kind of seems like that's exactly what's happening now. Could the rhetoric get worse from where we're currently at? Absolutely. Could it get better? Absolutely. So we just need to be mindful of these things. But at the very first onset, in terms of fundamentals in the week, in the beginning of May, we had a buy the rumor, sell the news event. And I'm kind of seeing a similar setup where in the first week of every single month, we have the NFP report. So what I want you guys to pay attention to in this report, keeping in mind that just recently, over the past, let's say 48 hours, we've seen the market slightly push back the odds and the probability of a Fed rate cut imminent, right? So the markets have continued to push back the odds of a rate cut. Now I believe the odds are at like 48% chance in September, when before in like April and the beginning of May, the market was pricing in higher probability of a rate cut in June or July. That is pretty much off the table right now. A very slim chance that that's going to be the case. So again, paying attention to data that we're going to get in June, if we can see those probabilities increase of a Fed rate cut more sooner or sooner, excuse me, than September, it could drive back risk on sentiment. And one of those key factors starting in the first week of June that we're going to get in terms of data that will decide that or give a market, impetus surrounding that is going to be the NFP data. So looking back at the first week of May, we got the NFP report. You can see NFP data calms recessionary fears. We know that an easing of recessionary tensions tends to drive risk on sentiment. You can see the date that this came out, 05/02 2025. All of these little tiny snapshots have dates on them. I'll save time to go through that, but you guys can kind of thoroughly see those. And it says here, following a solid US jobs report that brushed aside fears that the largest economy in the world is tied into a recession. And so it seems like the markets were already pricing this in before the news. So this was a prime example of a buy the rumor, sell the news event. So you can see at the end of April, Wednesday, prior to the event, which came out on a Friday, the markets were most likely pricing this information in. You can see a bullish rally as we ended April and headed into May. Then the market makers utilized this fundamental news event to sell on overly aggressive buyers that bought late, considering where market makers bought from, and they dropped price. They dropped price all the way down into a previous discounted area, and then following into the next week, Tuesday and Wednesday, May 6th and 7th, we got other supportive fundamentals. So you can see here, just expanding these to continue the risk on narrative. All right, it says here, long-term lower interest rates and steeper yield curve. So this was during the two-day Federal Reserve FOMC meeting, which took place on Tuesday, May 6th, and Wednesday, May 7th, when the actual announcement was released, and Jerome Powell spoke to the general public about the policy rhetoric and the overall, outlook for the Federal Reserve. So it says, we continue to expect the Fed to cut the federal funds rate later in the year, most likely starting in September at the September meeting, and the outlook is for 2 rate cuts. Interestingly enough, we're going to full circle back to this because it says it would likely take a significant rise in unemployment rates for the Fed to continue to cut interest rates, absent of a drop in inflation. So in June, to see rate cut probabilities come back to the table, we would ideally like to see cooling in the labor market. That would increase the probability of a Fed rate cut later on this year. But you can see, looking down at the dates, on Tuesday when this came out, when this information came out, markets probably priced in that this is going to take place. Wednesday, the actual announcement broke and the markets continued to rally. They continued to price in a high probability that the Fed is going to cut rates, which we know tends to drive risk on sentiment. Rolling into Thursday, looking at headlines in terms of tariffs, we had some Trump announcements. All right. These are going to continue to be our primaries in terms of reactive headlines. You can see the dates, May 8th, 2025. We had a whole barrage of announcements in terms of positive sentiment surrounding tariffs. Trump intended to make a deal with Europe, and we'll be dealing with Europe. US President Trump says China tariffs could also be lowered if talks go well. Trump also said he thinks that we'll have a good weekend with China, right? So this was one positive headline on the 8th. Looking down at the bottom of my charts, you can see this candlestick was Thursday, May 8th. At the same exact time, we also had other positive rhetoric from the UK and the United States. May 8th, 2025, US-UK trade pact leaves the 10% US tariffs in place. The agreement with the UK is in a full comprehensive tariff implication that will be positive, right? It says right here, this agreement will cement a relationship between the UK and the United States. So this was, again, positive headlines driving fresh bullish optimism to risk assets. Okay, and you can see that shortly after these announcements, the market continued to rally, and then we headed into the second week of May. All right, so the first week of May, We saw a lot of bullish announcements. We saw rate cut probabilities increase after the FOMC meeting, or at least the market did not deteriorate the odds of a rate cut on the table at later half of this year after the FOMC meeting. Even though Jerome Powell did come out with some uncertain rhetoric and a more hawkish leaning tone, the market did not dial back the expectations that the Fed was going to cut rates after the FOMC meeting. On top of that, we saw supportive labor market figures ease recessionary fears, which we know tend to keep optimism in risk assets. And then we also had tariff rhetoric support bullish impetus in risk assets as well. All right, so that was the first week of May. Rolling over, continuing these fundamentals. All right, so looking at this one, this is from May 12th, 2025. Interestingly enough, keep in mind, intraday price action could be bearish, where we see buyers taking profit, we see sellers trying to defend previous premium positions, and we see them trying to overpower buyers. When price comes down into a discount, sure enough, you can see right here, this is May 12th, Monday, 2025. Price was at a discount from where buyers were buying at on Thursday. Buyers came in, they defended their position, and at the same exact time, this is not coincidental, this is all systemically planned. These algorithms shift based off of headline fundamentals.
All of our risk models were powered primarily by quantitative signals. So we're looking at volume, price action, liquidity, depth, all these things across different markets. But oftentimes the vast majority of the time, the driver to all of this type of price action and volatility in the market is news itself. And when news breaks, now we can react to it much faster.
Right. It says here, the 12th of May, 2025, markets rise as US and China agree to slash tariffs. Share markets jump on Monday after President Trump said weekend talks had resulted in a total reset in trade terms between the US and China. Keep in mind that in one of the previous reports, Trump actually tweeted out that he believes over the weekend we might see positive talks between China and the United States. This was May 8th, a few days before, right? So we were covering all of this stuff here live in the community, where we were saying, let's remain optimistic. Let's remain on the right side of the market. Let's continue to buy until the rhetoric changes. Sure enough, when this announcement came out, you can see the market again bottomed out and started to increase in terms of price action. Moving on, this was a Thursday, May 15th, 2025. Let's look at the fundamentals. What did we have? We had lower inflation readings. May 15th, Thursday, we had core PPI figures and core retail sales all provide a fresh bet that the Fed is going to continue to cut rates in the later half of this year. We had inflationary metrics come out lower. We had core retail sales, albeit came out slightly below the expected and previous readings, not feed into any recessionary narrative and support the soft landing narrative. And then we also had PPI figures as well, right? Come out below previous and expected readings. Okay. And so that obviously, of course, kept the bid alive for rate cut expectations the later half of this year, which we know supports risk assets. And so looking at the date when all that information came out, we again see a supportive environment for buyers to take aggressive bullish bets, pushing price action higher. That then rolled us into this Saturday, Sunday price action. Now, looking at these tiny little pullbacks right here, you can see that these were also headline driven. So here we have an announcement, May 18th. This is from Reuters, from the Reuters terminal. It says here, President Donald Trump will impose tariffs at the rate he threatened last month. So we had a massive threat over the weekend on Sunday, I believe this was, May 18th, from Donald Trump mentioning that any trading partners that do not negotiate in good faith on deals, Treasury Secretary Scott Bessent said in a television interview, he did not say what would constitute good faith negotiations or clarify the timing or the announcement decision to return a country to the various rates that Trump initially imposed on April 2nd. And what did this do? That Sunday, the market makers utilized this headline. Sellers gained an upper hand on buyers. Any buyers that were late in the market buying at these tops got trapped in their positions. Sellers tried to overpower buyers, push price action down into lows. And then once price action came down into lows, interestingly enough, fundamentals broke again, and buyers were able to defend their previous positions. So the overall uptrend remained intact. Imagine how many people got fearful here, sold out of their positions, got a little scared. Overall, this just creates intraday price action and a pullback for buyers to defend their previous discounted positions. On May 19th, this is a Monday. So shortly the day after, we had probably one of the most bullish announcements this year, right? So far, in terms of liquidity conditions being solidified in global markets. We had a Fed speaker, Fed Jefferson. If you guys remember this, I actually remember trading this fundamental live. I remember specifically taking a buy position on Monday, which I usually don't trade on Mondays because of this announcement. But Fed Jefferson literally said that it's vital for central banks to stand ready to provide liquidity to global markets. Remember that the markets like certainty that if something breaks, central banks are going to come in and help the economy out or provide liquidity or quantitatively ease. Okay. And so that announcement provided shockwaves to global risk assets, and we saw stocks increase, we saw crypto increase, and sure enough, that is the exact time, the day after this announcement of this threat on tariffs created a decrease in the total cryptocurrency market or Bitcoin's price action. Then when price was at a discount, Fed Jefferson came in and announced this. I don't think it's a coincidence. I think it's all systemically planned. But sure enough, this created a higher low in the market and the markets continued to trend upwards. All right. Heading into the next day, Tuesday, the day after, what did we get? This is from a snippet of our fundamental report. It reads, May 20th, 2025, the crypto market stepped back into the spotlight today, adding roughly $16 billion in value as Bitcoin flirted once again with the $107,000 mark. The rally unfolded against the backdrop of deepening US dollar weakness, the very catalyst we have flagged in our May 18th report as one of the key tailwinds for alternative assets like crypto. So on that day, what did we get? It was a Tuesday, and we had the Moody's report downgrade the United States credit rating, and it dropped the value of the United States dollar significantly in terms of intraday price action. I think the dollar went down to like an intraday monthly low, and this rallied risk assets and gold as investors were hedging against the depreciation of the United States dollar intraday. All right. So you guys can see that fundamental piece live. And sure enough, looking at the timestamps, the 20th, it was a Tuesday, we saw again Bitcoin's price action significantly increase in value against the declining or weakness of the dollar, right? Moving on, heading up to where the market topped out. What did we get? Let's look at the price action. So this was Thursday, May 22nd. So we're starting to get closer to where we're currently at in terms of price action. All right. May 22nd, we can see here, this is another one of those fundamentals where if price is at a premium, you don't want to get too euphoric. And this is why I try to teach you guys to really position yourselves at a discount when you're trying to be a buyer, because you don't want to get trapped in buy positions. So here you can see we have a positive announcement on Thursday, May 22nd. But then shortly after, the market flipped risk off, and it was because of an inverse announcement that Trump made right after this. So Thursday, May 22nd, 2025, the EU has presented a fresh trade proposal to the US as it tries to revive stalled talks with President Trump's administration. The offer includes phased tariff cuts on non-sensitive goods, plus cooperation in energy. So the market took this as a positive announcement. But then, literally a couple seconds after, we saw this. Trump, on Truth Social Media, of course, moving the freaking markets like he does, said the European Union, which has formed for the which was formed for the primary purpose of taking advantage of the United States on trade, has been very difficult to deal with. Their powerful trade barriers, VAT taxes, are ridiculous, and their corporate penalties, non-monetary trade barriers, monetary manipulations, are all unfair and unjustified. So, long story short, he shook up the markets, and the markets took this as, oh crap, this is bad, right? Trump pretty much came out and bashed the EU. And so what took place shortly after, the market shed. This is exactly when this Truth Social Media took place. Look at the date, May 23rd, 2025. If you go back and you look at when the market recently topped out, it is exactly when this post was made. All right. So this just goes to prove that we are in a straight headline driven market environment. This has nothing to do with the underlying tech. This literally all just has to do with buyers and sellers in the market battling it out at buy and sell volume areas, buyers getting trapped in positions, sellers reacting off of headline news events, gaining the upper hand, and overpowering buyers temporarily, right? And so what happened after this? The market tanked all the way down into where we got another fundamental report, where then we see a bullish recovery. So the next bullish recovery that we got in crypto was on Sunday, the 25th of May, 2025. And sure enough, what came out? The inverse. So you can see down here at the bottom, we have May 25th, 2025, Donald Trump again posted out. I received a call today. By the way, this is again on a Sunday. I received a call today from Ursula von, I'm not going to butcher her last name, the president of the European Commission, requesting an extension on the June 1st deadline on the 50% tariff with respect to trade in the European Union. I agreed to the extension. So again, markets got hopeful. Buyers were able to come in. They were able to defend against sellers, and they bought at where they previously bought from, and they supported price, pushing price back up, trapping sellers at lows that sold late compared to where sellers up here sold from, and the market regained stability. All right. So you can see literally that this is a straight tit for tat headline driven environment where at highs or at premiums, something breaks and the markets sell off. When buyers step back in and defend their positions, it's usually due to some type of optimistic announcement where buyers can gain the upper hand or confidence to take aggressive bullish bets to defend against sellers. All right. So now looking at most recent times, what took place this week? Why did we see price start to stall? Why did we start to see sell pressure on Bitcoin? Hopefully you guys can answer that question in your own head. It was predominantly driven by dollar strength again, right? So we can see, given the recent fundamentals starting on Tuesday, which is exactly where the most recent top started to form and sellers started to show their hand, we saw upbeat US data. Well, I don't want to really call it upbeat US data, but we saw resilient US data, and that resilient US data did two things. It started to push back the likelihood that the Federal Reserve is going to be able to cut rates, not only in June, but also in July, and decrease the odds or the probability of a rate cut in September from, I believe it was previously existed at 60% down to a 48% chance. So we have now dropped below the 50% threshold of the odds of a rate cut taking place in September, which usually tends to do what? It usually tends to increase the strength of the United States dollar, decrease risk appetite, and that's exactly what we saw this week. So we saw dollar strength. We saw dollar, I believe it surged all the way up to like 99.958, maybe even higher, just off the top of my head. Those are the levels I remember from that intraday trading session. And at the same exact time that we got dollar strength, we also saw an increased probability that the Bank of Japan is going to hike rates later this year in October because we got higher inflation data from the Japanese front, right? So we had two metrics support fiat strength. So investors in risk assets hedged against that information. They sold risky assets at a premium and they bought US dollars, Japanese yen, so on and so forth. As we continued, the next day on Wednesday, we saw hawkish rhetoric from the FOMC meeting in minutes, which obviously, of course, all that information was gathered, I believe, on the 6th and the 7th at the beginning of the month, from getting those dates right, during the FOMC meeting. But the meeting in minutes is not released until weeks after, right? And you can see, looking at the headlines, these are just recent, 5 hours ago, 19 hours ago, dollar rises on higher bond yields and hawkish FOMC meeting in minutes. Gold extends losses on hawkish Fed minutes. We know when the Fed comes out with hawkish rhetoric, it tends to support dollar strength and weigh on risk sentiment, right? And so given this price action this week, we have predominantly seen sellers in control. Why? Because the headlines have not prompted any aggressive bullish bets. We have not seen any new breaking fundamentals that have supported a risk on environment or any new fresh headlines that support aggressive buying or for these buyers to come in and defend their prices. Okay. So you guys can kind of see the rhetoric from previous weeks were excessively bullish. Notice how all of the fundamentals from previous weeks are on the bottom of price action. I do that on purpose. The bullish headlines and fundamentals I put on the bottom of price action. And then the bearish fundamentals I put on the top of price action. And you can see just this week alone, the dominating driver of sentiment has been risk off headlines that have weighed on the prices of assets like crypto and stocks and have increased the strength of the dollar. All right. So that leaves us to where we're currently at now. Just recently, we saw a nice little tiny bullish uptick of hopium here, where we had this announcement. You can see risk assets slightly cheered. The U.S. Trade Court ruled on Wednesday that President Trump overstepped his authority in imposing sweeping tariffs in the country and trade partners. Personally, to me, this does not look like an aggressive bullish fundamental. Why? Because it just adds another extra added layer of uncertainty into the markets. And so that analysis on my behalf was correct. I mentioned to you guys today that I was being very patient. I was looking for lower levels before taking aggressive bullish bets. I did take one nice little tiny buy scalp, but outside of that, the market has been pretty shit in terms of buys this week because the primary drivers in terms of headlines have been risk off so far. Okay. So now that that has led us up to where we currently are trading at, let's go back to our overall fundamentals. You can now see full circle that these have been the primary risk on drivers. And now taking a look at this week alone, these have been predominantly all the headlines that we've seen this week. So you guys can kind of see full circle how exactly what I'm trying to teach you guys is what we need to continue to pay attention to moving forward. We've seen tariff talks collapse. We've seen hawkish Fed rhetoric. We've seen strength in the United States dollar. We've seen upbeat US data push back on rate cut hopes. We haven't really seen any Middle East tensions or escalations, but we have not seen any peaceful negotiations either. We have definitely seen an uptick in Russia-Ukraine rhetoric, where Russia, in just recent times, I believe it was like Sunday or Monday, attacked Ukraine again with a drone strike that killed multiple women and children. And so, on top of that, we're also seeing hawkish rhetoric from the Bank of Japan increase the odds, the chance, and the probability of rate hikes from the Bank of Japan. So all of the factors that I'm trying to show you guys this week paint a clear picture that this week's mood has been predominantly risk off. So let's kind of clear off the charts and let's just go over a forward-looking projection, take a look at some previous areas of interest on where we could possibly see buyers step back in, and go over the trajectory as we roll over into June. So let me just take a second and take all this stuff off the charts, and then we will go in and do a real quick overall analysis, risk on, risk off.